Have you ever looked at a massive financial company and just wondered, how does that thing actually work? Well, today, we're going to do just that. We are diving deep into Aditya Birla Capital, using their own financial reports from 2018 to see what's really going on under the hood.
It seems like a pretty simple question, right? But for a company this big, the answer is, well, it's complicated. Where does the cash really come from? That's the big mystery we're going to solve together in this explainer.
You know, the best way to get your head around Aditya Birla Capital is to stop thinking of it as just one company. Instead, picture a giant financial supermarket. It's this huge holding company with all these different aisles, or business segments, all under one roof, selling everything from loans to insurance.
And hey, that's not just me making up an analogy. The company itself, in its own filings from back then, calls itself a multi-segment business. That's not just jargon, it's their entire DNA, and it is the absolute key to understanding how their whole operation works.
Okay, so let's start where you'd expect, at the checkout counter, with the grand total. We're going to look at the big top-level numbers for the first quarter of 2018 just to get a feel for the massive scale we're dealing with here. So, in just the first 3 months of 2018, the total income, that's all the money flowing into the cash registers of this supermarket from every single aisle, was a staggering 3,070 crore rupees. That's the top-line number, the revenue, before a single bill gets paid. But, of course, you gotta spend money to make money, right? Running a supermarket this huge is not cheap. Their total expenses, everything from salaries to finance costs to insurance payouts, came in at 2,781 crores. That's a serious cost of doing business.
So, you do the math, income minus all those expenses, and we're left with a net profit of 201 crores for the quarter. That's the bottom line. That's what's left after everyone's been paid. It's a solid number, for sure, but the real story, the interesting part, is hidden in the details.
All right, now for the fun part. We're going to take a walk down the aisles of this financial supermarket. We're going to break down that huge 3,070 crore income number and see which specific parts of the business are pulling in the most cash.
And when you do that, wow, it becomes incredibly clear. You can see right away there are two undisputed heavyweights in this store. The NBFC, which is their lending business, and their life insurance arm. I mean, look at that chart. Together, they bring in almost all the money. They are the anchor tenants of this whole operation.
And let's put some hard numbers to that, because this is where it gets really interesting. Look at that. Life insurance and the lending business are practically neck and neck, both pulling in around 1,280 crores. But then there's this massive drop-off to the next biggest segment, asset management, at just 352 crores. This tells you exactly where the company's revenue muscle really is.
Hold on, though. As any good investor knows, a huge pile of revenue is great, but it's only half the story. Some of those high-revenue aisles can be really expensive to run. So the crucial question we have to ask now is, which of these parts of the business are actually profitable?
So now, we're shifting gears. We're moving from just looking at sales to looking at actual profit. This is where we get to separate the real winners, the true profit engines of the company, from the laggards, the ones that might be struggling or are maybe just getting started.
And this one slide tells such a powerful story. On one hand, you have the lending business, the NBFC, which is just an absolute profit-making machine, cranking out 335 crores in profit before the tax man comes knocking. But then on the other side, you have the health insurance business, which actually posted a loss of 65 crores. It just goes to show you the wild differences in performance happening under one roof. So here's the full breakdown, the profitability league table, if you will. The NBFC, as we saw, is the undisputed champ. Asset management is a solid number 2. But what's really fascinating to me is that life insurance, for all its massive revenue, is way less profitable. That makes sense, though. It's a long-term game. You have to keep huge amounts of cash in reserve for payouts. And then you see, right at the bottom, health insurance is actually losing money.
So what does all this mean? I mean, why would you run a business where some parts are making a killing and other parts are losing a fortune? Well, it all comes down to the company's big picture strategy, what we can call the diversification bet. You've probably heard this term before. Diversification is a classic business 101 strategy. The basic idea is simple. Don't put all your eggs in one basket. By playing in all these different sandboxes, lending, insurance, asset management, you spread out your risk. So if the lending market has a bad year, hopefully your insurance business can pick up the slack.
And here is the real genius of the strategy in practice. For a company like Aditya Birla Capital, this setup lets their super profitable parts, like the lending business, act as a funding engine. The cash they make over there can be used to invest in and grow these newer ventures, like health insurance, which, yeah, it's losing money now, but they're betting it's going to be a huge growth area in the future.
And all of this leaves us with one final, and I think really important question to ponder. For a financial supermarket this big, is this whole diversification strategy a brilliant safety net that ensures long-term survival and growth? Or is it actually a distraction where the money-losing parts are dragging down the true star performers? The numbers give us some big clues, but the real answer to that, well, that's the multi-billion-dollar question at the very heart of their strategy.